Hello everyone, welcome to our podcast. So today we are diving into the one of the hottest topic right now in the Indian financial market is continuously weakening of Indian rupee. So to unlock off this space, we are having a veteran in the forex market, Mr. Ritesh Victor, having the experience of 25 plus years. He is also co-founder and country head at Myforexeye. He has worked closely with lot of large corporates as well as MSMEs across India. So Mr. Victor, welcome to our podcast. It's a pleasure to have you here.
Thank you, Prabji. Thank you for inviting. It is a pleasure of mine as well.
So, Mr. Victor, since the start of this year, we are seeing that there is a continuously weakening of Indian rupee. So, can we say there is some structural change or it is some kind of short-term volatility in the market?
I think rupee has gone some degree of a structural change, and I would say it is a part of both. A bit of a structural change as well as change in short-term volatility. Rupee was overvalued for many years. RBI kept it under control. The new governor came late last year, and he made some changes in the policy. The exchange rate is now more market-driven. And obviously, middle of the year onwards, the US tariff has weighed on the sentiment. Okay, and if you actually see, the rupee has weakened since the middle of the year, since May, June 2025, till the first part of the year, since January till April, May, the rupee had a two-way volatility. First, it weakened and then it gained. But since May, June, it has faced continuous weakening pressure. So, US tariff has had an overhang. RBI having a slightly hands-off approach has an overhang. So, I would say it is a structural change, a bit of a structural change and a bit of short-term volatility as well.
So, we can say it's a mix of both.
Yes, absolutely.
Okay. So, Mr. Victor, in the previous years, we have seen that dollar index and dollar INR is having positive correlation. But in the recent past, we are seeing that there is some change in that correlation. So, we can say it is for a long term or it is also a short term change.
Okay, now that's an interesting question. Historically, we have seen dollar INR, dollar index having very good positive correlation. But that correlation in 2025, I think has been very erratic and irregular. We have seen a lot of periods of negative correlation. So again, if you see where dollar index was in the beginning of this year and where it is now, compare that with dollar INR, there is a big relevant difference. Dollar index was 108, 110 in January 25, and now in December 25, it is at 98, 99, 97. So there is a almost 7-8% decline in the dollar index. But rupee from 85, 86 has come to 91, and short term we have seen last 1 week it has come from 91 to 89.25. So the correlation has broken. I don't think the correlation will remain broken for a very long period of time. There are some issues which is driving rupee negativity, pessimism in rupee, that might be there in the short term, but ultimately the positive correlation will come back.
Okay. So what about the Asian currencies? How they have performed in 2025?
Okay. Actually, most of the Asian currencies have gained. If you look at Chinese yuan has gained. Look at Malaysian ringgit has gained. Thai baht has gained. Korean won had gained in the most part of the year. Last 2-3 months, Korean won has been a bit of under pressure. So I think if you compare all the major currencies of the world, rupee would have been probably the big outlier. Japanese yen is another slight bit of an outlier. They have weakened a bit. But rupee is the largest outlier. Beginning of 25 till now is like almost we are reaching the end of the year. So rupee has been the big outlier, weakening around 4.5-5% when dollar index has been declining, and most of the Asian currencies have gained. So the correlation there has also temporarily broken off.
Oh, yes. So we are also seeing a change in behavior of dollar INR. In the last year it was mostly range bound, but in this year it's been too much volatile. So can we say it's all about RBI, or there are some other factors that is affecting the volatility right now?
Okay. See, there, as I said, there is a structural change. 22, 23, 23, 24. We had seen RBI having a very tight control, and rupee was primarily range bound, very low volatility. But RBI let off that control, end of last year, and this year there was a bit of control, but intervention was very selective. So I would say there is a significant change in the RBI policy, which is driving the rupee. And in the last 6 months, obviously the US tariff has had a very big overhang. And another factor which I feel is a slight relative underperformance of Indian equities. Compared to the global equities, US equities, European equities, they have outperformed. Okay, so I think that is also have had some degree of effect on the rupee. We have seen a decent amount of FII outflows, and fortunately the oil prices are lower. So if oil prices would have been higher, it would have had a bigger negative impact on rupee.
Yes.
Okay, but that is under control. So I think RBI structural change and some structural changes in terms of the tariff. Obviously, we are at the receiving end. All those factors, pessimism, outflows, hands-off approach by RBI, probably letting the markets decide the rate, and which is probably letting the speculators also come into the market and trade. So all those factors have had a compounded effect.
But despite being such a strong fundamentals of India, GDP is growing, inflation is coming down, interest rates are also cutting by RBI, why there is too much pressure on Indian rupees?
Okay, strong macros, fantastic, very good. Probably we are the fastest growing large economy of the world, and we are at a very sweet spot where the GDP is growing very well and the inflation is controlled. Inflation is relatively quite low. So we are at a very sweet spot. But honestly, that has not had the effect on the financial markets. As I said about equities, there are developed markets have outperformed Indian equities. They have, if you look at US indices, if you look at developed Asia, you look at European indices, majority of them have given last year returns of anything between 12 to 18%. Okay, but if you look at Nifty, you look at Indian equities, we have barely given 9-10%. Okay, so despite really strong macros, the financial markets have not been rewarded, or it is not getting reflected in the financial markets. Underperformance of Indian equities, and obviously, as I said about policy changes, so multiple factors have had an effect, and trade deal obviously has had an effect. More than numbers, it is the sentiment that gets driven by such pessimism and negativity.
Okay. So, Mr. Victor, due to such kind of volatility, I have been in touch with a lot of exporters and importers. So, they have created some mindset, like exporters are saying that if dollar INR is in continuously uptrend, so what's the need of hedging? While importers are saying that on the first day of order, we should be fully hedged. So, what's your take on that?
Okay. Now, remember, risk management or FX risk management is an ongoing process. It is a continuous process, okay? And it cannot change because the market dynamics have changed, or it cannot structurally change because the markets have changed behavior. Okay, now, for all exporters who feel that there is no need to hedge, please be aware of the risk. If you are completely unhedged, and remember, it is an exchange rate. If you are completely unhedged and exchange rate moves like this, then your financial statements will also move like this. Okay, and we have seen it very well in the last 5 days. Rupee dollar INR from 91.0708. In 3 days, it has come to 89.25. Okay, so almost a 1 rupee 75, 1 rupee 80 paisa stronger rupee in just about 4-5 days. Okay, so if exporters feel that there is no need to hedge because rupee is weakening, fine. But remember, rupee will not weaken forever.
Yeah.
Okay, there are factors which are driving it, and these factors will evolve and change over time.
Yes.
Okay, so be very aware that with unhedged positions, your financial statements will be like this.
Yes.
And I'm sure no board and no promoter family would want their financials to be like this. They want stability in the business. They want stability in their operations.
Yes. So basically, to protect the margins and stability in the business and financial statements, so there's some kind of hedging is necessary.
Absolutely. Some degree of structured approach has to be there. You cannot expose yourself completely to the vagaries or the volatility of the market.
So what are the tools you suggest then for taking some hedges like forwards, options, or mix of both?
Okay. Now, tools will depend specifically on the industry dynamics, the sector dynamics, and the kind of a sector and product that they have. How sensitive is the product price to the exchange rate? So, it is a far more broader and a more dynamic concept. But generally, if you look from a risk management perspective, you should certainly use forwards and options both. Remember, the market dynamics have changed. Earlier, if you look at from 2000 to 2020, the dynamics were different. The forward premiums were higher, and the rupee weakening in general was lower, so there was a positive carry. So exporters used to hedge and importers were not hedging. But in the last 5 years, a lot of these dynamics have changed. Okay, the rupee weakening is more and the forward premiums are lower. So now the exporters are not ready to hedge and importers are very, forward looking and keen to hedge.
Yeah.
Okay, so, but remember, 20 years something, what was there, what was established, that changed in 5 years.
Yes.
And there is no assurance or guarantee that this dynamic will remain. It might change again.
Yes.
Okay. So coming to the conclusion, the criticality is you should hedge, you should have a structured approach, and it is always better to do vanilla options in addition to forwards, because vanilla options will give you that degree of flexibility if the market goes in your favor. Forwards it protects you only on one side. If market goes against you, it protects you. But if market goes in favor, it gives you a negative cash flow. Okay, so the most desired or optimum hedging strategy is using an optimum mix of forwards as well as vanilla options.
So it's a mix of both.
It's a mix of both.
Okay. So Mr. Victor, as you mentioned about forward premiums, so most of the time in this year, premiums were ranging. It started from 3%. It came down to 1.5% and stayed between 1.5 to 2.5%.
Yes.
But what has suddenly happened? That premiums has suddenly shoot up in the recent weeks.
Okay. Rightly put, majority of the year 2025, the forward premiums have been around 1.5 to 2.5%. It shot up in December primarily because of 2-3 factors. First factor, the RBI did a swap. He did a 5 billion buy-sell swap just about a week back. Okay, and that helped the rupee to gain, but the premiums to go higher. So swap was one effect. And also understand the changing dynamics in interest rates, US interest rates and Indian interest rates. Sorry, because that is what is going to ultimately impact the forward premiums. US interest rates have come down and a larger probability of more rate cuts going ahead, and Indian interest rates have come down and a probably slighter lower probability of Indian interest rates going down further. Okay, so the disparity has gone slightly higher. So changing interest rate dynamics is another factor which tends to push the hedge cost or the premiums higher. And I think there is some degree of liquidity impact as well, because we are reaching the year end, calendar year end.
Yes.
And we will see such kind of an impact in the calendar year end and a similar impact in the financial year end as well, in March as well. Okay, so some seasonal factors, some economic fundamental factors, and obviously the swap that RBI did. So all of them have happened at one time, and that is why probably we have seen a magnified effect. I think the premium should have been around 2.75-3%, but it has overshot and gone up to probably 3.5 and 3.75% in some selective months.
Correct. So, Mr. Victor, you have shared a lot of things with us. So, at last, for our audience, to sum up all of your own experience, what's the suggestion you right now want to give to our audience in this volatile situation?
Okay, a few suggestions that I can tell from experience. Okay, is obviously you need to have some kind of an approach, some kind of a structured approach. There is no point in going to forecast the market. Okay, it's absolutely futile. Irrespective of the amount of years you spend in the market, you will never be able to forecast. Sometimes you will be right, sometimes you will be wrong. So there's no point in looking externally to have a process or a structure. It has to be internal. Okay, you need to look at your business, your sector, your profit margins. So the basic bottom line is to stop forecasting Okay, market dynamics are too dynamic and they will keep changing. And always remember, the markets will change faster than you can change. Okay, so by the time you think, react, and make a change in your process, the market will change its structure. Okay, so a more professional or a much wiser and prudent strategy is to have an approach. Okay, and do hedge, keep unhedged positions to a slightly lower levels, and hedge using forwards and options both. Options will give you protection and will give you flexibility. Forwards will only give you protection and no flexibility. So it's better to have both kind of instruments, both kind of structures in place to manage risk. I usually tell most of my clients it's an extraordinary time. It is a giant or a Goliath kind of a risk, and with this kind of a risk, you cannot use pebbles or small stones to overcome such kind of risk. So you need to have extraordinary solutions for such kind of extraordinary times, and those kind of extraordinary or really rewarding instruments are those vanilla options. You can do structured options selectively to reduce the option premium, but remember, despite the volatility that we have seen in dollar INR, the dollar INR options volatility have not gone up very high. It has obviously gone up a bit, but it has not reached peak levels. It is still below the long-term averages. So typically, despite being volatile, the option premiums are slightly on the lower level, more palatable. I would say 1 month option, 2 month option, 3 month options are very attractive, still very lucrative compared to the volatility that we are exposed to. So bottom line, have a structured approach, use forwards or options both. Futile to predict the market, don't predict the market, don't use the market to change your strategies. You can modify and review strategies, but don't flip it and change it. Okay, and try and keep unhedged positions to a lower ratios. I'm sure you're not there to speculate and earn from foreign exchange. You're there to protect yourself.
Okay. So we had a great interaction with Mr. Hitesh Victor today. So we discussed a lot of things, but to sum up, we mainly discussed on that why rupee remained mainly pressure throughout the year and what are the key takeaways from this session. I would say it is very much futile to predict the market. You should have some kind of strategic approach to manage the forex exposure. So thank you, Mr. Hitesh Victor, for all the wisdom.
Thank you for inviting, and there were some really good intelligent questions. Thank you, Prabhjit.
So thank you everyone for being part of our podcast. For getting such more forex insights, you can subscribe to our YouTube channel.